Okay, hi, good evening, everyone. Thanks for joining me here today for this session of online webinar again. So my name is Ethan and I'm hosting today's webinar from the IG Singapore office. So I understand that we may have some audience that's tuning in from the other regions as well. But right now in Singapore, it's about 7 p.m. So if you are in Singapore like me and having your dinner or on your way home from work, please just feel free to sit in as well to learn more about this session. For today, right, I just wanted to do a very simple options webinar because previously, as I conduct some of the webinars, a lot of the feedback that we received was to talk about options. So there's a lot of viewers for our IG webinars asking more about options trading. I think there are a lot of new traders as well who wants to learn a bit more about options. Hence, we have this options 101 session today. So today's session will be very introductory. I'll be sharing options in general and what are some of the very common option strategies that people use when they are trading options. But before I do a quick before I start my presentation, I just wanted to do a very simple mic check. So as usual, if you are able to hear me right, please try to locate this question box. Be it you're joining from mobile or your desktop, in the GoToWebinar control panel, right, you should be able to locate this question box. So I'll just encourage you to try to find this box because as and when if you have any questions, you can also type it in. And time and time again, I will just take a look at the questions and I'll answer them to my best efforts. But if you can hear me right now, please just type in a yes in the question box so I know that on the technical side of things, everything is working fine. Okay, thanks Dave, thanks Reddy, thanks Katie. I see a lot of people typing yes already. Okay, so the audio is working fine, so I'll just move on to the seminar proper, okay, without further ado. Okay, before that, I just wanted to very quickly introduce myself again. So my name is Ethan, Ethan Lee. So I'm the education lead here in IG Singapore. And before IG, I was in another local brokerage called Philip Futures, but they've since rebranded to Philip Nova. So this is just a very rough background about me. With regards to the role-wise, back then I was more of doing like on the business development side of things and also like an account manager for the traders. Okay. So now I'm in IG and just a very quick disclaimer. So everything that I share with you today is primarily for educational purposes only. Please don't treat anything that I share with you as trading or investment advice. As always, if you are trading CFD or any other products, please do your own due diligence before you place any trades. Okay, so nothing that I say today is trying to induce you to place any of the trades with us. So just take note about that. Okay, and this is an overview of what I will be sharing today. So I'll be going through the basics of options, the different types of options, primarily call and put options, longing and buying and selling options, why people trade options, and some of the common option strategies as well as trading options on the IG platform. Okay, so this is what we will be covering today. And let's just dive straight into it because there's a lot to unpack. Okay, so just before I start, I just wanted to highlight that options is actually one of the more complex products. Okay, so you may find that the session today could be a bit confusing, it could be a bit heavy. So if you need to take down notes or if you have any questions, please just try to type in the question box and I'll answer them as I go along as well. Okay, so this is a very heavy topic, but let's just start into this topic. Okay, so when we talk about options, right, and options trading, so what exactly is options trading? Basically, when we talk about options trading, right, it refers to the buying and selling of options. Okay, and when we talk about options itself, right, buying and selling these options actually they refer to contracts, and these contracts offer you as a options buyer the right but not the obligation to buy or sell an underlying asset at an agreed upon price and date. Okay, so the key thing that I want you to take note from this definition is that if you are buying the options and holding the options contract, then you are not obligated to buy or sell the underlying asset if you do not wish to. Okay, so you have a choice there. And usually when we read this explanation, it is as good as not reading, right? Because it sounds very complex. So don't worry, let me try to further illustrate with some examples as well, so we can all have a better idea of what this means. Okay, but before I do so, I just wanted to highlight that for options, there are two types of options. The first type is what we call a call option. Okay, so call option is basically an option that gives the option buyer, this call option buyer, the right but not the obligation to buy something. So to buy what? To buy an underlying market. So when we talk about underlying market, right, this can be a index futures contract. It can be a stock. It can be shares. Very commonly, people are trading equity options. So usually people are referring to the shares. And this options contract, it will include details such as the strike price, the agreed upon price, and an expiration date, which is a set date. Okay, so just take note that when we talk about call option, when we talk about call, it's just the right to buy an underlying market. Okay, and conversely, there is the other option product that we call the put option. And when we talk about put option, instead of having a right to buy, this time we have a right to sell. Okay, and of course, the same thing, there is an agreed upon price on what price you can sell, and there is this set date, which is the expiration date. Okay, so the agreed upon price is known as the strike price, and we refer to the set date, it is known as the expiry or expiration date. Okay, so just to give you an example, because all this right now can sound very confusing, I can understand. If you are first time hearing call and put options, it is a lot to absorb. But just imagine right now in real life, okay? So in Singapore, right, if you notice the prices of durian, right, fluctuates here and there, right? Sometimes the durian is a bit cheaper, sometimes it's a little bit more expensive. So let's say one day you are looking to eat durian, okay? So let's say you happen to walk past this durian store. Okay, and you notice that the durian price today is very reasonable. Okay, so you notice that the store uncle is selling the durian at just $10 today. But let's say if you just have your dinner and you don't feel like eating the durian today, but you felt that the price was very reasonable and you may want to have it sometime later. So what you can do is that you go up to the durian store owner, hypothetically, you can tell him, let's say, uncle, I want to buy this durian from you at $10 today, because this is the price that you're putting there right now today, right? But I want you to help me to keep it first, okay? So I'll come back in the future to buy it again from $10. So I'm willing to lock in the price today at $10, but I don't want to eat it today. I want to come back to another day, to consume it another day. So maybe the durian uncle, he thinks about it and then he tells you, okay, sure. So what I will do is I will issue you this coupon. Okay, so the uncle issue you this coupon, which will entitle you to buy a durian from the uncle at $10. But of course, this coupon that he issue you is not free of charge, right? So he doesn't give you a coupon for free, he charges you for it. But with this coupon, you are entitled, okay? You have the option to buy one durian from him for $10. Okay, so this $10 is known as the strike price. And of course, he doesn't give you this coupon to last indefinitely, right? Doesn't mean this coupon, you come back 5 years later, you still can buy it from me at $10. Okay, so no. So let's say the uncle tells you, with this coupon, you can come back to me, present this coupon to buy one durian at $10, but there is an expiration. You can't come back too late. You have to come back by the end of next month. Okay, so you come back before the end of next month. There's an expiry to it. Okay, so what you do is that, let's say you're okay, and the uncle say, okay, so to buy this coupon, it will cost you $2. Okay, so to lock in the durian price at $10, I will charge you $2 for this coupon, and then you come back anytime between now until the expiry. You can actually just buy a durian from me at $10. And of course, you receiving this coupon, right? You have the right to choose. So let's say you want to come back to buy the durian at $10 is okay. But let's say if you don't want to come back to buy, you can just don't care, right? You can just not visit him again. Okay, so you don't have to honor this. It is up to you as a options buyer, right? Just imagine this coupon is an option. As an options buyer, you don't have to exercise it if you don't want to. Okay, so just imagine again a month later, right? So after 1 month later, you decided that you want to go back to eat the durian now. Okay, so let's say you already have the coupon, you want to eat the durian now, and you go back to the same store. And the price of the durian today, a month before it was $10. So today the price has already went up. So probably it's either that the durian supply has cut down a bit or the demand has went up, so he increased the price of the durian. But you tell him, okay, so last month I came back, last month when I visited you, I bought this coupon from you. So with this coupon today, I want to exchange it to buy it for durian for $10. Okay, so what he has to do is that he has to honor what he sold you previously, right? So previously, if you recall, just let me on the pointer, just 1 second. So previously, recall this coupon is not free, right? He didn't issue the coupon for free. This coupon costs $2. Okay, but by paying these $2 to get this entitlement, what it does is that you can actually buy a durian from him instead of $15. You can buy it from him at $10, and it is still within the period that he has within this tenor. Okay, so what happens is you give him the coupon, he gives you the durian, you pass him $10, so your total cost instead of $15 is $12, right? $10 for the durians and $2 for the coupon. But just imagine, right, if today the durian price is $15 and today is the first time you met this uncle, if you want to lock in a contract to buy a durian at $10, do you think the premium to buy this coupon will still be at $2? Okay, so if you think about it, right, it doesn't make sense, right? Because with this particular coupon, if the details of this coupon is telling you that you can actually buy at $10, then logically, if you think about it, this particular coupon has a $5 intrinsic value. Okay, so minimally he should charge you for $5 because if you pay $5, you can actually buy a durian for $10. So there's intrinsic value in this particular coupon because the price here is lower than whatever the market is quoting today. And of course, again, if let's say you have the coupon, right, you can choose not to use the coupon. It's entirely up to you. Your only cost is just the premium as a options buyer. Okay, so I hope this makes a bit of sense to you. It gives you some sort of idea of how options work. But I will just quote you with more examples again as we go down the session. So I hope that it's able to provide you with more clarity because I understand all these examples can also be very confusing still. All right. So the thing about options is that very similar to the last example, right? So this coupon gave us a right to buy, right? So a right to buy again is what we call a call option. Okay, so with this particular piece of contract, right, you can go back to buy something. And buy something, the buy what and at what price is basically details in the contract as well, known as the options contract. So in the contract, it will tell you, is it a call option or a put option? Okay, meaning to say, is this contract giving me the entitlement of a right to buy or a right to sell? And it also states very clearly what is the strike price. So meaning to say, at what level can you buy or sell the underlying market at? And of course, it comes with an expiration date. So this expiry can be a weekly expiry, can be a monthly expiry, can be a yearly expiry. So just take note that if you think about it, right, the longer the contract, right, then obviously the cost of the premium will be higher, right? Because there is a higher chance for that particular piece of contract or the options contract to make money, right? So if I issue you a contract that's going to expire in the next day, probably it won't be very expensive because there is not a lot of a chance or probability for the price level to hit. But if I offer you a contract that will last 1 year before expiration, then obviously within a year there is more chance for the price to hit, right? So logically speaking, the longer the contract, right, the more expensive the premium of the option will be. Okay, so just imagine this example. So let's say that if the example is a call option, and to recap, the call option is this, is to allow you the ability to purchase an underlying stock or underlying market. But in this case, we will use a lot of examples on shares trading because that's the most popular market that most people use options for. And by purchasing these call options, right? So for example, the call option has a strike price of $100 and it expires within 30 days. So what this means is that by purchasing this call option, it gives you the ability to purchase the underlying stock at $100 strike price anytime within the next 30 days, regardless of what the stock price is. Okay, so if you have this call option and the stock is trading at $200, it doesn't matter. This particular contract will allow you to buy the stock at $100. Okay. Okay, so in this example, right, of the same example just now, call option, strike price at 100, expiration is 30 days from now. Exactly the same example earlier. So what happens here is that, let's say if you have a right to buy at 100, right? So let's say if you have a call option and this is the underlying market, let's just imagine this is ABC Private Limited, okay, company ABC. So let's say if you have a right to buy ABC at 100 and the share price went up to $120 within the next 30 days, then fortunately for you, since you own this call option, you're able to purchase stocks at $100 even though the share price is currently trading at $120. Okay, so just be very mindful. This is the example of a call option, and call option means that it allows you to purchase. Okay, so the next example here is just the opposite of a call option. This is what we call a put options. And in this example, right, let's say if the type is a put option, the strike price is at 100 and it expires 30 days from now. What it actually means is that if you are buying this put option, it allows you to, instead of purchase, right, you can now sell the underlying market. So let's say if this underlying stock again is ABC Private Limited, you can sell ABC Private Limited at $100 per share anytime within the next 30 days, regardless where the stock is trading at. Okay, so just to quote you an example, let's say if you have a call option that is over this particular price level, which gives you a right to sell at $100. If the share price happens to tank to $80, right, then with this call option, you can actually present it to your seller, right? So you're buying the option, the one who sells you will have to honor the word. So you can actually sell him, instead of $80 per share, you can sell him at $100 per share. Okay, so by owning this, it gives you the right to sell the particular share at $100, even though the current market is trading lesser. Okay, so just to quote you an example, right, because you may be wondering, right, why would someone then want to buy options? Because options is not free, right? It's not somebody just telling me that I give you a right and then it's just words. It's not free. There is some monetary value tied to this piece of contract, right? This options contract, because it costs money, right? So does it actually then make sense for us to purchase them? Okay, so if you look at this example of a put option, right, to provide you the ability to sell an underlying market at this agreed upon price at a set date, just imagine, right now in this scenario, let's say you are a family man, okay, but for some reason as a family man, you decided that you want to buy a Lamborghini, okay, you want to buy a sports car. You definitely need to purchase insurance, right? Because this will protect you financially in case you get into an accident. So what you need to do is that you need to look for this insurance provider, and then you need to pay them a premium, right? Okay, you pay the insurance provider a money, and in return, what will they do? They will insure you, right, with an insurance contract, right? And in options trading, you can think that this is the same concept as well. So why do people want to buy put options? Is also because if you have underlying shares, right, if you're already holding a existing investment portfolio, and you know that, let's say during the COVID period, you hear a lot of news, you know that there's a lot of lockdowns, and you know that the share price is going to tank in the near future. What you can do is that you can actually purchase this insurance, so that in case if your view was right and the market really went bearish, then this option contract, this put options contract specifically giving you a right to sell, will actually protect you. Okay, so conceptually is a bit like the same thing. But in the context of equities, right, like I shared with you earlier, so example, if you have an existing portfolio right now, and your portfolio right now is that you bought 100 shares of ABC Private Limited, and your entry price is actually $100 per share. So right now, 100 shares at $100 per share, you actually have a $10,000 exposure. Okay, so this $10,000 is also your max risk, right? Because if the share price happens to drop to zero, okay, then like in the previous example, right, if you have the options contract, right, then you can actually be insured of this downward movement. You won't make the loss. So in this context, what happens is that you as an investor, right, what you're doing is that you're paying money to purchase this put options contract from an options seller. And the question may now be, this option seller, who is this option seller, right? So if I'm buying a put option, then who exactly is this seller that's selling me? It's not an insurance company, right? So again, in options trading, this put option seller is any other trader. It can be you, it can be me, it can be anyone who is willing to be paid to assume this risk, right? So now you're offloading your risk, right? So you're buying a put option to offload this risk. So who is actually selling you is anyone anyone that is willing to take this risk to be on the opposite side of the trade. Okay, so it can be you, it can be me, and what happens here is that, let's say if you are an investor, you want to protect downside movement, and by purchasing this put options contract, you pay a premium, options premium, to this option seller. This option seller could be anyone, and what these option sellers do is that he will honor you this contract to protect you. Okay, and what entails in this contract is specifically, is this a call option or is this a put option? Is this at what strike price, right? So at what price do you want to sell or buy the shares at, and what is the expiration date? How long should this contract be valid for? Okay, so back to the example, right? So let's say if you have bought 100 shares of ABC Private Limited at $100 per share, you have this 10K exposure. And what happens here is that you bought a put option that expires 30 days with the same strike price. Okay, so meaning to say, just to recap again, put options means giving you a right to sell. So I have a right to sell someone ABC shares, ABC Private Limited at $100. But of course, this right is not free, right? For someone to give me this options contract, this right for me to sell him, I need to pay him money, right? So let's just assume very hypothetically that it cost me $300 to purchase this insurance, this put option contract. Okay, so what happens here is that if you have a right to sell at $100, okay, so this is your entry also. So you bought 100 shares at $100. At the same time, you bought a put options contract to a right to sell. Okay, so maybe you already have some existing shares before. Okay, so you're already holding it, and right now you're just trying to protect yourself from some downside risk. So you have paid $300. And what happens here is that if the market happens to go up, right, it went up to $110 per share. So what this means is that you will have made a profit, right? Because you have owned 100 shares at $100 entry price. Right now, if it goes up to $110 per share, then you have made $10 per share. And since you own 100 shares, that is a profit of $1,000. But because you bought insurance, right? So what it means is that there is a cost associated with this. So the cost of this is that you need to pay $300 premium, and that reduces the amount of profit. So there's kind of like a additional cost to you, right? Because you paid a premium to insure this position, and by doing so, right, your profit, if the market went up, right, you will have received lesser profits. Okay, and of course, when this happens, you're probably thinking to yourself, right? Wow, this options contract that I bought was a waste of money, right? Why would I spend this $300? And then the other side of the trade, right? The seller probably smiling, right, year to year, and telling you, right, thanks for the easy money, right? Because they get to keep the full $300 that you paid them, and they don't have to do anything, right? But in the other example, let's say if you have a right to sell at $100 by owning this same exposure, you bought this put options contract with $100 strike price, which is the right to sell at $100. But in this scenario, the stock went against your view, and you dropped down to $90. Okay, since you own 100 shares, right, you would have lost $1,000, right? Because $10 per share, you have 100 shares, that's $1,000. And since it went down by $10, your net loss is actually $100 initially. But because you bought this options contract, right, you have the right to sell the option seller ABC Private Limited at $100. Okay, so what this means is that instead of selling it at $90, mark to market at $90, and take this $10 loss, right, this whole movement, right, can be mitigated, right? Because the options seller now, you have the right to sell it to him at $100 instead of selling it to the market price at $90. Okay, so the option seller is obligated to buy your shares at the strike price. Okay, so he cannot tell you, oh, I don't want, the share has dropped to $90. I don't want to buy it from you at $100 already. He can't do that because he has collected the $300. He's assuming the risk now. He is obligated. He have to. Okay, so in this case, right, even though you paid $300, right, you didn't actually lose this $1,000 movement down, this 10% drop, and hence your net loss is only $300. And of course, what happens to the seller is that they can actually, since you have the right to sell them 100 shares at $100, right? Of course, they can hold the 100 stocks now and hope that the price go back up, or the option seller can sell it directly to the market and take the $1,000 loss. But he's not going to take the full $1,000 loss, right? Because he has already collected $300 from you. So his net loss, instead of $1,000, he lost $700. Okay, so I hope that makes sense to you. Possible for the possible for the option sellers to default? No, because the broker side, right, on the broker end, when you are trading options, the broker will take note of the margin, and the broker will track whether this option sellers has enough margin requirements to honor the contract. So if it doesn't have enough, then the contract will be liquidated as well. Okay, so if there isn't enough money in the trading account for the person who sell you the option, then the broker will do something about it. So as an option buyer, you just need to note that the seller will definitely be you have to honor that in one way or another. And anyway, you don't know who the seller is. The brokers on the other hand will need to manage all this for you. Okay, so another example, just to reinforce your understanding, just imagine right now, instead of shares trading, let's take a look at example of a commodity, right? Gold. Okay, so just imagine gold, if it's trading at about 1920, and you buy a put option. Okay, so by buying this put option, it gives you a right to sell at 1900. So imagine this is the strike price. Okay, so you buy out of the money put option. It's trading at 1920, but you have a right to sell at 1900. So what you do is that you pay a premium. The opposite side of the trade, the seller, he receives the premium from you, and there is an expiration. So just imagine this is 2 weeks from now. And at this point in time, right, nobody, not you, not the seller, nobody knows how the gold price is going to react, right? Nobody can forecast the market, right? Everyone just has a view only. Okay, so whether your view is right or wrong, nobody knows until the market proves itself, right? But let's say in this case, if the gold price happened to close lower, okay, by buying this put option contract with a 1,009 strike price, right, you are able to sell gold to this option seller at 1,009, and you can realize a profit, right? Because let's say if gold is trading below at, let's say, 1870, you're actually able to not sell at 1870. You can sell it at $30 above the market price at 1900. So you manage to capture a bit of the profit there. So the maximum gain as this put option buyer, if you're buying this put option, you're buying a right to sell at 1,009, your maximum gain is substantial. I'm saying substantial and not unlimited because there is a cap, right? The cap is 1,009, right? Because if gold price goes to $0, that is the maximum you can gain. And of course, the maximum loss for the seller is substantial as well, because if it goes to $0, you have the right to sell him at 1,009, even though it's worthless. Okay, so another example again, imagine gold is trading at 1920, same thing, you bought this put option right to sell at 1,009. You pay a premium to be entitled this right. The seller on the other hand receives the money from you. There is an expiration. But of course, this time, right, if the gold price close higher, right, then there is no reason for you as an option buyer to sell gold to him at 1,009, right? Because it makes more sense for you to, if you want to sell gold, you can sell it to the market at 1960. Okay, so your maximum loss will be the premium you paid to buy this right or this options contract. And then the seller, his maximum gain is just the premium he received. Okay, I hope this is not too confusing. I understand this a lot to absorb. And what we shared earlier was just the put option example, right to sell. So now if you look at the call option example, in an example of this shares trading, right? So let's say right now, if you want to buy 100 shares at $100 per share, you will need $10,000 capital, right, to actually buy 100 shares at $100. So the alternative is, if you don't want to come out with a huge chunk of money to buy 100 shares, what you can do is that you can buy the option contract. So you can buy a call option that expires 30 days with a $100 strike price. And this option contract, again, is not free, it's $3 per share. Okay, so in this scenario, let's say if you happen to buy at $300 over here at this level, and eventually the share price went up to $110 per share. Okay, so of course, at this point when you purchase, you have no idea whether the price will go up or go down. Your view is that it should go up, and hence you have a bullish bias, so you buy this call option. And in this scenario, you got it right, and the share price went up to $110 per share. So what you can do is that you can actually exercise this call option. Okay, so what it means is that by exercising this call option, you decided to actualize this options contract and exercise your right to buy at this lower price at $100, because you were paid, right? You paid $300 to have this right. and there was a willing seller that's willing to collect this $300 from you to give you this right to buy 100. So now that the share price went up to $110, you're actually able to get it at $10 below the market price. But again, if you calculate your profit, right, you don't actually get the full movement from 100 to 110 because you need to deduct this $300 that you paid. Okay, so instead of earning 10%, which is forking in $10,000 as initial capital, wait for price to appreciate 10%, right? And then to sell it back at 11K and earn that 1K. Alternatively, you can spend $300. Just an example, this amount is not fixed. Just an example, hypothetically, if it's $300, then you would have made $700. Okay. And again, if you have a right to buy at $100, right? Same call option example, and the share price didn't go up, it went down instead. Then your maximum loss, instead of owning the shares, right, and having a loss of 10K, right? Now your maximum loss is just $300, right? Okay, so the losses, if you have purchased the shares, it will be $1,000. But of course, if you are just looking to speculate with options, your max loss is just this options premium. Okay. Okay, so next, again, back to the example of gold. So imagine if it's trading at 1920 and your view is that you're bullish, okay? So you decided to buy a right to buy at 1940, okay? Why don't want to buy at 1920? If it's trading at 1920, why you don't want to buy a right to buy at 1920? Of course, you can buy at 1920, but just take note that the closer the strike price to the current market price, the more expensive the premium will be, okay? So let's say if you take a cheaper alternative, you have a bullish view and you decided that if gold price went above 1940, I want to give myself this right to buy a 1940. I decide to buy this call option contract with a 1940 strike price. So what do? I pay a premium. The opposite side of the trade, he receives the premium from me. There's an expiration. And again, at this point of time, nobody knows whether the gold price will go up or the gold price will go down. Your view is that the gold price will go up. The seller view for selling you this call option is that he may think that the gold price won't go up above 1940. So he decides to take the risk and receive this premium from you, right? So what happens here is that if the gold price did indeed close lower and the seller was right, there's no reason for you to exercise, right? You don't have to tell the seller, oh, since I buy this from you, I need to buy gold from you at 1940. No, you don't have to. As an option buyer, just remember the durian example. If you are not the seller, if you are the buyer, you have the option to choose whether you want to exercise or not. In this case, it doesn't make any sense to buy gold at 1940 when the market is trading, let's say, at 1870. So your maximum loss is just the premium you paid, and then the seller will just say thank you for the free money. Again, he receives the premium and move on, right? Move on to the next trade. But in this example again, so let's say you happen to buy a right to buy, but in this example, the price did went up. Okay, so let's say if the price went up and you decide that, okay, I want to exercise now to buy at 1940. Okay, so this line is not supposed to be here. Okay, so this line is supposed to be over here. So it's within the expiration date. It's not past the expiration. So I plotted the line wrongly. So please pardon me for that. So assuming, let's say if this line was over here and prices indeed did went above 1940 before the call option expire, right? So what happens is that if the gold price closed higher, then you as an option buyer, you can exercise the right to buy gold at 1940, even though it's trading at 1960. Okay, so again, in this example, right, by buying this call option, right, your profits is unlimited because you don't know how high gold price can go up to, right? Hypothetically, there should be a reasonable cap, but of course, nobody will know. It can actually go up to 2,000, 5,000, 10,000, 100,000. Nobody knows. So the profit gain is unlimited, and the maximum loss for the seller is also unlimited. Okay. So just a very quick recap of what we covered so far in the past 30 minutes. We talked about call options, which is the right to buy something. Put options is the right to buy, right to sell an underlying market. And of course, for these two types of options, right, call or put options, you can actually be a buyer. You can buy a call option. You can also sell a call option. You can also buy a put option and sell a put option. Okay, so two types of option, each type can buy or sell. Okay, so just be aware of this for now. And for options, right, there are also a few reasons why people trade options. So if you think about it, for the commercial players, right, so let's say if they are producers, they are trying to hedge their downside. Okay, so let's say imagine this scenario, I'm an oil producer and I know my cost very well. I know to produce 1 barrel of crude oil, maybe it costs about $50 for me. Okay, I know my cost. And currently the crude oil price in the market is trading at, let's say, $80. So what can I do this right now is that I can actually buy a put option contract at $80 strike price. And to recap, put option is a right to sell. So I can actually sell someone a right to, I can actually sell someone at $80 with this put option contract. And two scenarios here, right? So let's say if the crude oil price from $80 right now, let's say a month later, it became $100. So what happens here is that if I buy this contract, a right to sell at 80, it is of no use to me, right? Because I don't have to, as an options contract buyer, if this is unfavorable for me, I don't want to use it. I will just sell crude oil at the market price at $100, okay? And what I lose will then be just the option premium that I paid to buy this entitlement. But of course, in the event that the crude oil price from $80, it dropped to $65, then I can actually exercise this contract, right, to sell crude oil at $80 to the option seller. Okay, so that's one reason. And of course, what they are trying to do here is to allow them to mitigate their exposure, right, by declining crude oil prices while retaining this ability to benefit from potentially higher price. So they protect themselves from downside, but of course, they still retain their ability on the upside. So they bought this put options contract. Okay, so this is just a very layman concept of hedging in general, whereby you can look to mitigate downside risk, similar to the previous shares example, whereby if you are holding shares at a particular price, you can actually buy put options on the shares that you are holding to protect your shares. Okay. So the next reason, of course, more popular will be speculation, right? So a lot of people, they actually speculate on options because why? Number one, it offers you a lower cost to either go long or short. And with this lower cost as well, it gives you a predefined risk, right? And this risk is just limited to the options premium. So if I spend $300 to buy this call options contract, then my max loss is just $300 if the options is worthless. Okay, and of course, if you're not looking to buy and you're looking to sell options, right, what it means to you is that you are now the insurance writer. You can actually generate income, right? So by assuming the risk from others, you can actually generate income. And with options, it's also more flexible because in trading, right, sometimes you think about going long or short is bi-directional, right? So you can profit from either long or short. My options trading, you can actually profit if the market is consolidating. Okay, so that's one way of a view. If your view is that it's consolidating, then you can actually profit using options. I will share a little bit of the common strategies of how people do that later. And of course, you're not just limited to buying options only or selling options only. You can mix and match. You can buy and sell options concurrently. Okay, so I'll share with you again later on some of the common things that what people are doing. How do they combine this to form some, if they have a view, how do they combine using options to play their view? Okay, so again, some of the reasons would be because they think the share price, they think that the prices will go higher, but they want to limit their losses. They know that by buying options, their losses is capped, so they don't lose more than that. Or they may play on the volatility. They think that markets are about to get volatile. They may actually try to use options to speculate that. And they can concurrently buy, call, and put options for a directional neutral strategy. Okay, so before I continue, I just wanted to highlight some of the common terminology that you may have come across, or if you're dabbling into the world of options, then this will be useful for you. So just take note, a lot of the common terms that you will see is things like strike price. Okay, so in an options contract, is it a call option, is it a put option, there will be a strike price. Okay, so this is the price that you need to agree with the seller. At what price can I buy, or at what price can I sell? And of course, there's a premium. This is the amount of money, the cost price of the options that you need to pay. And the premium of the option is actually that there are three factors that will affect how much the option costs. Number one is the intrinsic value. So just think about the durian example. If the coupon allows you to buy it at $10, but the current market price is $15, then the options is minimally, there's an intrinsic value of $5, right? Because with this particular contract, you can already buy at a discount. or if the contract is a put option and you can sell underlying share at $100, but currently the market is trading at $90, then there is already an intrinsic value of $10, right? So minimally the option contract need to worth $10, right? And of course there's time value as well. The longer the contract expiration, then the more expensive it will be. And of course there is the volatility part as well. The more volatile the underlying market, the more expensive the premium will be. Okay, so intrinsic value is the amount that the option is in the money. Okay, so what do we mean by in the money? Is the difference between this agreed price and the current market price. Okay, so there's also time value. So this is the part whereby it depends on how long the life of the option has before the expiration. So that's the time value. And we talk about this portion, right, in the money. Okay, so what it means by in the money is that if your options contract is a call options contract, then it means that the current market price is above the right to buy. So if the right to buy is 100, the market is trading at 120, then this call option is in the money. And opposite put option, if you have a contract which is a right to sell, then the current market price is below the strike price. Okay, so that means that the put option is in the money. Out of the money is just the opposite. So meaning to say if you have a right to buy, but the current market price is below this right to buy price now. And again, put option, right to sell, current market price is above this strike price. So that's out of the money. Okay, so if you look at the platform, right, this is like an options table, right? So you notice that in this options table, it can be a bit confusing, but just let me try to break it down for you. Over here on the top right, what you see is that this is the underlying asset live price. So maybe let's say, I think this was S&P 500 when I took the screenshot some time back. So let's just assume that S&P 500 is trading at 4,306 points. Okay, so this is the current price. And in the trading platform, if you can see there's a thin line here, I'll just highlight for you here. So this is just the reference on the live price. So if the live price is 4,306, the options contract, this is the strike price. There are many different strike price you can choose. It just shows you that this line here is where the market is trading in between 4,310 and 4,300. And you notice that over here, right, there are two categories, right? There's a call option, there is a put option. Okay. So you notice that under the call options and put options, you have two actions as well. You have the choice to buy a call option, you have a choice to sell a call option, you have a choice to buy a put option and a choice to sell a put option as well. And you notice that call option is the right to buy, right? So right now, if the market price is 4,306, and if the strike price is going lower as you look at this table, right? As I go up over here, the strike price is lower and lower. You notice that all these options here is what we call in the money, because you're able to buy all these options at a lower price than what the market is quoting. Okay, and you notice the numbers inside these boxes. This is the premium, the amount of money you need to pay to actually have a right to buy S&P 500 at 4,180. Okay, so if it's trading at 4,306 and the lower the right to buy, right, then the more expensive the premium will be. Make sense? And of course, if you are looking to buy call options or sell call options, the higher the strike price, and these are out of the money already because it is higher than the market is quoting right now, then the cheaper it will be, right? So if the market is trading at 4,360 and you're buying a right to buy at 4,400, naturally as you go down this table, the premium gets cheaper and cheaper. Okay, I'll move a bit faster because I noticed left about 15 minutes and I still got quite a bit to share. So on the other side is just the put option. So this is just the right to sell. And if the market price is here and you have the right to sell at a increasing strike price here, the premium gets higher and higher. These are all in the money. And of course, if the strike price is lower and put options, remember again, it is the right to sell. The premium will get cheaper and cheaper. Okay, so now we talk about some of the common option strategy that people will use. Okay, and the first most popular strategy is what we call the covered call. Okay, so covered call is a strategy whereby you are already holding, so you already have a portfolio of the underlying shares. But what you want to do is that while holding this portfolio, you sell an out of the money call option. Okay, so to give you an example right now, let's say you already have shares at ABC Private Limited. So what you can do is that you can actually sell. So you're not buying an option now, you're receiving money now. You're receiving to sell this call option. Market is trading, let's say $100. But as I'm holding the underlying asset, right, I sell someone, what am I selling? I'm selling someone a right to buy the shares from me at $110. Okay, so what this means that there's also an expiration date. So if the option expires in the money, meaning to say if market actually went up above this particular call option, then what happens is that you as an option seller, you will need to sell your, the buyer will tell you, okay, since you sell me this right to buy at 110 and the market is trading at 120 right now, I want to buy from you at $110. So you as an option seller, you need to honor your word. You need to liquidate your shares and sell them at $110. Okay, so the reason why people use this as a strategy is because, right, as you are holding the underlying market, right, so let's say at this point of time, right, you're just holding the shares and you may have a take profit target. So you may tell yourself that, okay, if the share price reaches $110, then I want to close out the trade and take the profit. But instead of putting in an order to just sell, right, why not you use options, right? So while I wait for prices to reach $110, I can actually make money while waiting. And how do I make money? I sell call options. Because irregardless, if the price, even if it went up above 110, right? If I didn't sell options, I would have also closed my trade at $110, right? Because I don't even know how far it will trend above. I just know that if it reaches $110, I'm closing my trades. That's it. So while waiting at this point of time, right, while waiting for it to go up, I can keep on selling call options and collect the premium. And of course, if the prices didn't even go up and if it went down, right, you can keep on selling the call option and keep on receiving the premium as you wait for prices to reach your target. Okay, so what happens here is that if prices did go up, then you as a seller, you need to exit because why? The buyer will tell you, you sold me this right to buy 110, now it's $120. This option contract is favorable for me as a buyer. I will want to buy from you at $110. Okay, so you as option seller, you need to honor this. And of course, the trade-off here is that by doing so, right, you actually limit your profit, right? Okay, so you cap it at 110 because that's your strike price. But of course, while you're waiting for this price to reach this level, in the meantime, you're collecting money, right? So you don't know you don't know when prices will reach this level. You're just waiting. As you're waiting, you're monetizing this time, right? So you're trying to monetize this time value as you're waiting. So what you can do, sell a call option. And this call option is out of the money. So this is above what the market is trading, is out of the money. You're just waiting for prices to hit and collecting premium. Okay, so you can think of it like a take profit level. Okay, so by holding the underlying first, then you sell. Okay, so if you are selling a call option without holding the underlying, then that is not a covered call because you are in no way you are covered. You don't have the underlying. If it happens to you are just doing a naked sell call, right, without holding the underlying, then if the prices went up, then your losses is not covered because someone will tell you he wants to buy from you 100 shares at 110, but you don't have the shares in hand to sell it to him. Okay, so that's when your losses could get a bit crazy. So this particular strategy called the covered call, you need to hold the underlying share first. You need to have a portfolio first. And while waiting for prices to reach your level, you can sell out of the money call options to collect premium. Okay, and the next one is what we call a cash covered put. Okay, so this is a strategy when you sell an out of the money put option while having enough cash in your trading account to buy the shares. Okay, so what do I mean is this. So let's say you notice this ABC Private Limited is trading at this particular range and you have a view. Your view is that right now it is more than $100. I think it's a bit too expensive, right? I don't want to buy now. I only want to buy when it reaches $90. Okay, so this is my entry level, my buy entry. So instead of putting in an order to buy at 90, right, I can again monetize this time, right? While I wait, I sell a put option. Okay, so over here, you don't need to hold anything. What you're doing is that you are selling a naked put option at $90. But what you want is that your account needs to have enough balance, right, to actually to really buy it at $90, right? Because this option contract, I forget to share, one contract is actually 100 shares. Okay, so if you are selling one contract, right, put option at $90, you need to buy $90 share price times 100 shares. So that is $9,000. So if you are selling these put options to collect the premium, and your view is that I want to enter this trade at $90 per share, logically speaking, if you're not selling the option, you're just buying the share, you also need $9,000, right? Just that now as you're waiting, instead of putting in an order to buy it directly, right, I collect premium in the meantime. But if prices did indeed drop below, Okay, so what happens is that now you are the seller, you're selling someone a right to sell you because this is a put option. So what happens is that in the event that the market drops to, let's say, $75, then you as an option seller, you need to honor your word, right? Because the buyer will now tell you, I bought a put option from you at 90. Now the market is trading at 75. I want to exercise my right to sell it to you at 90. So you as an option seller, you need to buy from him the shares now at $90, which is also your initial intention, right? If your initial intention was to enter the trade at $90, then this would have made sense to you. And instead of just putting in an order and not collecting money as you wait, what you can do is you can actually sell an out of the money put option before prices drop. And if prices did indeed reach your level, then this will be converted to $9,000. But of course, your cost, your acquisition for these shares will be lesser than 9,000, right? Because in the meantime, you are still collecting premium. Okay, so this will lower your cost per share as well. Okay, so if this expires in the money, then the buyer will tell you he's going to sell you at $90 because the market is trading lower. And you as an option seller will now need to buy from him 100 shares at whatever strike price. Okay, so this is the second way that people use options. So this tool that I share is the more straightforward one. And of course, if you are coming from a investing background or like you're trading on shares primarily, then this could be useful to you. Okay, so you can think of it like a buy limit order, right? So instead of buying at market, if you have a view to buy lower at market, which is a buy limit order, why not you consider selling put options contract? Okay, so essentially it's the same thing, but you're collecting money as you're waiting for prices to reach. Makes more sense, right? So that's why it's very popular. And the more complex strategy you may have heard about, of course, you don't need to really go and memorize and things like that. Just take note of all these concepts of the possibilities of options. Okay, so next one is what we call a bull call spread. Okay, so when people are trading this bull call spread strategy, right, their view is that they think that the underlying market is likely to have a small increase. Okay, not a very big one, a very small increase. So what they do here is that they actually buy out of the money call option and sell another out of the money call option with a higher strike. Okay, I know it sounds very confusing, but just let me show you over here what it actually means. So what it means here is that you buy an out of the money call option, right? Because it's trading at $100, example. Instead of buying at $100, if your view is that it may actually go up in the short term, but not a lot in a range over here, you can actually buy this call option, meaning to say you have a right to buy this ABC Private Limited at $110. Okay, so you pay money for this, but to reduce the premium that you pay, right, what you can do is that you can actually sell another call option with a higher. So you are combining a buy and a sell call option. Both are out of the money. And what you're speculating over here is that if the prices eventually, your view was right? Your view was that it was going to have a small increase. And if indeed it traded in this range, right, between your strike price, right, what it will mean over here is that your call option over here that you bought, right, you can actually exercise it to buy the shares at $110, even though it's trading at $120. And the call option that you sold at 125, this is worthless, right, because the market is still trading lower. So you collect the premium here, and you actually profit from this this call option trade over here. And of course, you paid money to actually buy this call option, and by selling this call option, right, the higher strike one, you reduce your premium as well. Okay, so just to put it in context, example, this one, if it costs you $3 per share, and you bought it over here, you sold the out of the money one. Of course, the higher the strike price, the further it's away from the market, the price, the premium will be lesser. So imagine if you bought it at $3 at this level. To sell here, you can only sell it for $1. So the net cost for you is $2. But of course, if it expires within, then you would have made money. But the trade-off is that if you bought this call option here and you sold this call option over here at this level, if the market didn't go up and it just went down all the way, then you would have lost the premium over here, but you wouldn't have lost the full thing because you collected just a little bit back from here. You would still have lost money, but at least the amount is lesser because you offset the premium you spent by selling another out of the money option. Okay, so that's that. And the opposite side, we have the bear put spread, right? So again, your view over here is that the underlying market is going to have a very small decrease. So what happens here is that you can actually buy a put option contract. Let's say the strike price is at $90, and you can sell another level down, which is at $80. So what happens here is that if the stock price goes up, right, then this options contract is worthless because, right, you bought a right to sell. If you are buying a right to sell at 90, you will only profit from this trade if the share price went below 90, and then you have a right to sell at 90. So if the share price went up above 90 to, let's say, $100, this is typically worthless. But of course, you paid money for this, and by selling this put option, you manage to offset a little bit of the cost over here. So there's a downside and upside to this, right? So the downside is that you actually limit your profit potential. Because in the event that the market crashes to $0, then these put options that gives you the right to sell at $90, right? You cannot get the full swing from 90 to 0, right? Because you don't only have just this position, you have another layer over here that actually caps your profit at 80. Because instead of buying, now you are the seller. You're selling somebody a right to sell you at 80. Okay, I understand this is a bit confusing, but just know that with options, you can actually have combine and interesting stuff like that to actually take advantage. Okay, so again, if you buy at a particular premium, if you sell it, you can actually offset and have a lower net cost. The next one is that if your view is that the market is ranging. Okay, so earlier, remember I shared that you can also profit from ranging market. So if your view is that it's not going to go up anytime, it's not going to go down anytime, it's just going to stay in a range, can I actually use options to profit? Yes, right? So if you think that the market is ranging, what you can actually do is that you can sell options, right? So you sell somebody a right to buy at $100. You sell somebody a right to sell you at $80. And if your view was right and markets did indeed trade within this range, right, then eventually when the option expires, both of these options will expire worthless. Okay. And what you receive is that you will receive the premium for selling this and this. Okay. But of course, if your view was wrong and the market didn't range and it broke out either side, depending on how far it broke out, right, whether the premium you receive can cover the amount of losses. If it broke out very exponentially, then of course your losses will exceed your premium received. Okay, so just take note that this is actually one way that you can speculate for ranging market, which is what we call a strangle, where you sell out of the money call option and you sell out of the money put option. Okay, and the other side is that instead of selling now, right, if you are buying, right, so your idea is that the markets may break out. If you know that it has been consolidating, but you're not sure whether it will break out to the upside or it will break out to the downside. Okay, so what you can do now is then instead of selling just now, right, if you think of selling, you're just trading within the range, right, hoping that the markets don't break out, right? But if your view is opposite now, you think that it will break out soon, then what you can do is you can buy a call option at out of the money. You also can buy an out of the money put option. So regardless where the market breaks out, one of the trade will actually make money. But of course, if it didn't break out and you traded within the range, then of course your losses will be the premium you paid. Okay, I hope this is not too confusing. And very similarly, right, there's also this thing called straddle, long straddle. Okay, so again, the same thing. You think that the markets will break out, but you're not sure which direction. But instead of buying out of the money, right, you're buying at the money now. So if it's trading at $100, you're not buying like earlier, right? You buy a right to buy at higher and buying a right to sell at lower. You're paying more money to buy it at the current market price. Okay, so again, this is an unlimited profit potential because if it happens to break out any side, you already have a right to buy at the current market price and a right to sell at the current market price. Of course, if you compare this with earlier, the strangle, this will be more costly, right? Because this is at the market. Okay, so this is a more costly option. Okay, I think I'm a little bit short of time, so I just wanted to very quickly go through all this. So right now, what are for IG, right? If you talk about options, right, our options is not the traditional options. What we offer are CFD options. And we talk about CFD options, right, back to the durian example. Okay, so if you recall, you have a buyer, you have a seller, right? The buyer pays the seller a premium. The seller gives the buyer an options contract. Of course, in the earlier example, when I shared that actually the contract, you can actualize it, right? You can actually get the underlying shares. You can actually use the options contract to sell off your positions. You can use the option contract to get into positions and things like that. But for CFD options, right, what you are speculating here is not all this. So it is just, you're just trading the premium. Okay, meaning to say, the amount of money I need to buy this call option and the amount of money I need to buy this put option, how much is this amount right now? What is the premium? So by buying this options contract, you're not able to exercise one. So let's say if you are trading a Tesla option with us and the options the options close in the money. You bought a call options, meaning to say, let's say you have a call options to buy Tesla at $230 per share. Okay, and Tesla went up to $280, and then you tell IG, oh, I want to now buy Tesla shares at $230. Okay, so that's not how it works with IG. You're only trading the premium. So at that point of time, if the premium to buy that share at $230 strike price when the market was trading at, let's say, 230, maybe it costs $1,000. But if it has gone up to $250, right, the premium right now, instead of $1,000, it may have went up with the intrinsic value to maybe, let's say, $5,000. Okay, of course, it's just a rough estimate. The intrinsic value will be $20 difference per share times 100 shares. You add that in, so that is the minimum amount in the options contract. So in a way, it is still quite fair, but you are not able to actualize the shares. What you're trading here is the premium. Okay, and the premium will be actually very fair as well. So if you look at the trading platform, right, on the left-hand side, right, you will be able to see what we call the options. Of course, this is currently not by default. We don't enable this for clients. If you are keen to trade options, then you will need to call into our help desk or email them. It's an opt-in basis. And when you click on the options, right, it will give you a different asset class that you can trade over here. And it's also filtered by the different expiration. And when you click on the expiration, right, or the different product, right? So over here, you see that this is US 500. Let's say you want to look at the US 500 options contract. You click on the expiration, they will come out this options table, right? Which is what I showed you earlier. Okay. So what you want to do is then you click on this add to workspace button and you will be able to see this options table. Okay. So you can actually scroll through the different expiry here as well, or you can actually look at back then the previous menu. And of course, on the right-hand side of the table, you will see if you're already a client of ours, this will be very familiar, just like a normal CFD trade. There is this view tab. Okay, and if you click on this info tab, you'll be able to see more information such as when is the expiry date for the options contract and things like that. Okay, what you want to do is that you want to click on the premium. Okay, so let's say right now, if you are looking to buy a call option, if it's trading at 4304, you want to buy an out of the money call option. Means your view is that S&P 500 will actually go up. You can actually buy this options contract at 77.7. Okay. You click on the premium, this table will appear, right? So it will tell you, okay, 77.7 is $10 per point. The margin required is 777. Okay. And to look at the chart, right, you can click on these three candlesticks. Okay, when you click on these three candlesticks, right, you'll notice this is the options chart. Just take note, this chart here is not the underlying S&P 500 price movement. Okay, so what you see here, right, is actually the options premium. So again, what you're trading on is the premium. How much is the options worth for this particular strike price? Of course, you can have another screen to look at S&P 500, the index price. This is just the options price. So if S&P goes down, right, the options price can actually go up as well. Okay, so just be very mindful. This will not be exactly the market movement of S&P 500. This is just the premium of the options that you click into. Okay, so this is just this portion, the numbers over here, the boxes. If I buy it now at 77.7, in the chart is showing the price now at 77.7. So this is actually what is plotting. Okay, the options premium. And this is what you're actually trading. Okay, you're actually trading the difference in the premium. So example, if you buy this options contract, right, and S&P 500 did indeed go up, then when you want to close your trade to sell it, right, you will notice that the premium has already went up. To close off the trade, you have made a profit. So if you bought this contract at 77.7 points, if you manage to sell it, let's say at 100 points, then you will have realized the difference between your entry and exit of this options premium. Okay. So of course, when you buy the options contract, you do not, firstly, with IG, you do not pay or receive it first. It's still based on margin trading. And over here is what we call the margin requirements for the options contract. Okay, so if you look at over here, if you're on the buy side of the trade now, okay, so when you're looking to buy an option, the margin required here will be this dollar per point. Okay, how much dollar per point multiplied by the options price over here. Okay, and then you notice that there's a margin here. Of course, if you buy it and you close it immediately, this margin will be returned to you. And if you're looking to sell the option, right, to collect the premium, right, then the margin required will be over here. Okay, so this is exactly the same as the margin required to short the S&P 500. the non-options contract. So if you are trading a normal CFD to short as US 500, right, this is the margin required. But for our options, we require the same amount of margin as well. And just take note that this is the premium of the options. So let's say if your view is that you want to collect premium, right, and you are selling it for 75.5. If this option expire worthless, right, then you can actually buy it back at $0. Means you have earned a total of 75.15 multiplied by $10 per point, which is 750 US dollars. And if this whole particular contract that you sell was out of the money during expiry, so there is no value already in it, and you already collected the premium earlier. Once during expiry, you will see that your position is net off against to buy back. We close it back for you at 0, so you have earned this premium. Okay, same thing for shares as well. So if you manage to sell your shares, share call or share put option at a particular premium, and those particular options that you sold expired worthless, then it will be marked to market to $0 at the end. Okay, so you have earned the full amount over here. But of course, if you want to buy options contract, then this is the amount of the options premium that you need to pay. Okay, so for options, again, no commission. We don't charge any commissions for CFD options. What you need to be aware of is just the spread over here. So you notice that to buy the options and to sell it, immediately when you buy or sell, there is a price difference, which is in this case is 2.8. So that is the cost to you. Okay. So on that note, I just want to very quickly wrap up for IG. So we have gone through a bit of options today on call and put options. We shared some examples of how it actually works, shared a little bit of strategy. I understand it can be a bit confusing, but I hope you get the idea and concept well on the movement, whether you can profit from upside. If your view is just a very small increase, what you can do like a bull call spread. If you just want to long the underlying market, you can just buy a call option. There's many ways to mix and match call and put options, and you're not just limited to buying call and put options. You can buy a call, sell a put. You can buy call, sell call. There's many ways to do it. Okay, so online also there's a lot of different materials that you can actually read up on. But essentially just some final notes for IG. There's no assignment, or you cannot exercise the CFD options. You're just trading the price of the options contract. Okay. And of course, you do not pay or sell the premium immediately. You're actually using margin. You're executing a position based on the initial entry of the options premium. And your profit and loss will be based on at the point of exit, right? If I'm buying, what is the closing price of the options? Okay, so by closing price, what I mean is that if I bought the option, it will settle against the selling price. If I sell the options, it will settle against the buying price. So that's the opposite side. So if I buy the option at $100, when I exit the trade or when the option expires, right, is the option worthless? If the option is worthless, then you will have spent the $100, you have paid $100, and that's your max loss. But if the option was right, so let's say if the call option had a strike price of 4,003 for S&P, and during the expiration, S&P was trading at 4,005, then the closing price or the selling price will not be 0, right? So by paying 100, maybe the closing price is 500, then you will have gained a profit of 400. Okay, so that is the difference for IG options. And always remember this, you're just trading the difference in the price of premium when you're talking about CFD options. Okay, and for the options, just take note that for IG, there's only market order for the premium. So you cannot say that if the market is quoting me $77 for the premium, I only want to buy when the premium reaches 60. Okay, so the order ticket doesn't support that as of now. So you can only execute a market order. Okay, so I've come to the end of my this very introductory session on options trading today. I hope it has been of use to you. I thank everyone for staying with me throughout, and we have over exceeded by about 10 minutes. I will leave you to enjoy the rest of your night. And once again, I want to thank everyone for staying with me throughout for this seminar, and have a great night. Okay, thank you.